Opendoor stock is up more than 300% this year, but it just missed 2 out of 3 of its own guidance targets. Now it's down after hours, trading at $5.59, and management just announced that they're pivoting from being a house flipper into an AI software company. So my question is Opendoor the next great AI turnaround story, or just a real estate business trying to rebrand before the crash? Because think of it. Revenue, it's down 33% year over year. Adjusted EBITDA missed by nearly 47%, and losses per share widened to 12 cents. Yet the stock's still up triple digits. That doesn't happen by accident. Something, either the fundamentals or hype, is driving this price action. And I think I found something that no one else is talking about. Buried in the third quarter report, there's one line about how they'll succeed by building technology, not from charging high spreads. But if you read between the lines, their roadmap still screams iBuyer, not AI platform. And that's why in this video, I'm going to show you why that pivot doesn't add up to me, what Wall Street's really betting on, and the key number that could make or break Opendoor's future valuation. Hey, what's up? My name is Rick Orford. I've been trading since 1999, and no, I'm not a financial advisor. That's a good thing. I break down the numbers so retail investors like us can make smarter, more confident decisions with their money. So with all that out of the way, let's dig into Opendoor, because the story behind this rally might be very different from what most investors think. I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. And you all know how much I love researching new stocks and trying to find the next best investment. So I'm proud to partner with The Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market by almost 6 times. Go to fool.com/RickO to get your 10 stock picks right now. Opendoor Technology, of course, is a real estate tech company that operates as an iBuyer in over 50 US markets. Here's how it works. Homeowners, they post their property. Opendoor buys it for cash, makes repairs, and resells it on their own platform. Buyers can then search by zip code and tour homes online. It's basically flipping homes at algorithmic speed. And everything happens online. No open houses, no staging, no parade of strangers walking through your living room. In Opendoor's words, you get to skip the hassle, request a competitive cash offer, manage your sale online, and even choose your own closing date. Now, all the recent hype surrounding Opendoor is not because the company launched some revolutionary new product or reinvented online real estate. The stock actually achieved meme status, which is why its price went from around 50 cents to where it is today. Now, Chairman Keith Rabois says he's gone on record to say that Opendoor is not a meme stock and that the massive price movement is driven by demand and genuine investor belief. He even said that consumers are voting with their feet. And that's a bold claim, because if he's right, this might be more than just some short-lived rally. Well, the company did just release their third quarter financials, so we're going to look into later to see if there has been a fundamental shift in the numbers, because the numbers, they don't lie. They tell us whether this move is real or not. For now, let's have a look at the stock price, because let's be honest, that's why you're here, right? The stock recently closed at around $6, but it's already trading lower after hours. At the time of recording, the stock is trading at $5.59. That's quite a drop after reaching a high of $10.87 in September. And volatility like that doesn't happen by chance. It's emotion, speculation, and fear all colliding. But if we zoom out, the stock is still green. It's up 310% year to date and 268% over the last year. And here's the thing, sustainable triple-digit returns don't just happen without seismic changes in the company's financials or business. And the fact that it's already lower after hours, immediately after its financials were released, not a good sign. Whenever price runs ahead of performance, gravity eventually shows up. So let's take a look at the numbers, something we love to do in my Discord channel because real investors, they don't gamble, they measure. Now, in the previous quarter, management issued revenue guidance between 800 and 875 million, adjusted EBITDA of a loss between 28 and 21 million, and a contribution profit of between 22 and 29 million. Now, remember, these numbers, they're the targets that management set for themselves, and missing them matters a lot. EBITDA is a common enough term. In case you don't know, it just means earnings before interest, taxes, depreciation, and amortization. But contribution profit, this is very unique to Opendoor. It tells us the amount of profit that Opendoor earns after accounting for all direct costs tied to home sales. It's their own unique version of gross profit, laser focused on the homes they actually flip. Lastly, analysts expected the company's losses per share to be around 7 cents, and that's already pricing in some improvement. So a miss here could hurt. Now, Opendoor just released their third quarter financials. Let's see if they met their guidance, starting with the top line. For the third quarter of 2025, Opendoor reported revenue of 915 million, which is great, exceeded expectations. But it represented a decrease of over 33% year over year. But they did beat the forecast, right? And that's good. It's like running faster, but still falling behind. But there is a problem. Even on an adjusted basis, EBITDA missed guidance by almost 47% at the midpoint. That's not a small miss. That's management losing almost half of the margin they aimed for. And the company also missed contribution profit guidance by 10 whole percentage points. So even their core operations, buying, fixing, and selling homes, didn't perform nearly as planned. And last, losses per share, 12 cents. That's nearly double what Wall Street expected. Not good. And when earnings miss by that much, sentiment, it turns fast. So the company missed out on 2 out of the 3 guidance metrics that it set last quarter and missed analyst bottom line estimates as well. But what about future guidance? Because sometimes the market can forgive a bad quarter if the next one looks promising. Well, let me tell you, it doesn't look that good to me either. Q4 revenue is expected to be 35% lower than this quarter, so around 595 million. Adjusted EBITDA loss is expected to be almost double this quarter, and contribution profit has been swapped out to contribution margin, which is also expected to be lower quarter on quarter. Whenever a company changes the metric that they guide on, pay attention, because it usually means they're trying to shift the focus. So that's it for the numbers. But the report also contained another big piece of information that's not been really covered. As of Q3, their CEO announced a pivot. Opendoor is moving from the iBuyer business to becoming a software and AI company. And that single sentence could change anything or nothing at all, right? According to their CEO, business will succeed by building technology that makes selling, buying, and owning a home easier and more joyful, not from charging high spreads and hoping the macro saves us. But here's the thing. Calling yourself an AI and software company typically means more than using AI behind the scenes. It means building something that others can use, turning your internal tools into a platform that clients can access and pay for. And there's zero mention of making their internal technology or any of their software into a product in the 3 objectives that they laid out in this report. In fact, these 3 goals are still all about the iBuyer business model. So that despite all the AI talk, their focus still seems to be firmly on flipping homes, not selling tech. It's still just a real estate business with a fancy label. So I say this isn't really a pivot, it's a rebrand, and investors can usually spot that a mile away. By the way, I cover many popular stocks on this channel, and this won't be the last time I discuss Opendoor, so make sure to watch out for it in the future. Now, With all that out of the way, is Opendoor stock a buy at these levels? Well, to answer that, let's have a look at what Wall Street thinks about the stock, because sometimes the smartest move is to see what the pros are quietly doing. Right now, a consensus among 12 analysts rate the stock a hold with an average score of 2.5. The high target price is $6. This tells me that even the best case scenario barely beats where it's trading right now. And look at this. Both sell and strong sell ratings have increased in the last 3 months. That tells you that the analysts are starting to lose patience. And when that happens, liquidity dries up fast. It also doesn't help that the Q3 wasn't anywhere close to being what the street was expecting. And this will likely have an impact on analyst scores moving forward. But what do you think? Will Opendoor ever escape its meme stock label? Are you owning, or are you holding? Are you buying the stock? Let me know in the comments below, and why. And while you're there, if you found the video helpful, don't forget to like and subscribe, because it helps others find the video, it supports the channel, and you won't miss out on any of my future deep dives. Well, folks, that's it for me today in this video. I want to thank you so much for watching, and I'll see you next time.